Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of a complete guide to discounted cash flow, DCF, analysis for business valuation. Ever wondered how investors decide if a business is worth their money? That's where discounted cash flow, DCF, analysis shines. It's a method to estimate a company's value by looking at future cash flows and what they're worth today. This approach helps businesses, investors, and analysts make smarter financial decisions. Whether you're valuing a startup or assessing an investment, understanding DCF is key. In this video, we'll break it down step by step. Understanding discounted cash flow, DCF, analysis. Discounted cash flow, DCF, analysis is a cornerstone of financial decision-making. It's relied on by investors to gauge whether an investment is a smart bet and by businesses to estimate their worth. To truly grasp this method, it's important to understand what it is, where it came from, and why it functions as a bedrock of valuation. Definition of DCF analysis. At its core, DCF analysis is a method of determining the present value of future cash flows. Instead of looking at what money might be worth years from now, it adjusts for the time value of money, the principle that cash today is worth more than the same amount in the future due to its earning potential. Simply put, it asks, what are tomorrow's dollars worth today? The process involves forecasting future cash flows, then discounting them back to their present value, using a discount rate, often reflecting the risk or return expectation. By summing these discounted cash flows, you get an estimate of an investment's or company's intrinsic value. Done right, it provides clarity in a world of financial uncertainty. This analysis isn't just about numbers. It's about understanding risk and reward, recognizing the impact of time, and making smarter choices in finance. History and evolution of DCF analysis. DCF analysis didn't appear out of thin air. Its roots trace back centuries when early economists explored the value of money over time. In the 1800s, concepts like interest and discounted future payments began to take shape. These ideas laid the groundwork for modern valuation techniques. Fast forward to the 20th century, and DCF became a standard tool for businesses and investors. Economists like Irving Fisher and John Burr Williams formalized the method, connecting cash flow projections with intrinsic value. Williams, in his 1938 book The Theory of Investment Value, popularized the idea of assessing investments by future earnings discounted to their present worth. In recent decades, as businesses became more complex and accounting standards evolved, DCF cemented its role as a go-to valuation tool. Thanks to advancements in technology and software, analysts can now perform intricate DCF calculations with precision, making it more accessible than ever. Today, DCF is not just a financial framework, it's a universal language in valuation. From large corporations seeking acquisitions to small investors sizing up stocks, it remains one of the most trusted methods for calculating worth. Key components of DCF analysis. Performing a discounted cash flow, DCF, analysis requires breaking it down into 3 main components: projecting cash flows, determining the discount rate, and calculating terminal value. Each plays a critical role in ensuring the calculation is as accurate and meaningful as possible. Cash flow projections. The backbone of any DCF analysis is cash flow projections. Without these, you're essentially guessing a company's future worth. The goal here is to estimate how much cash the business will generate over a specific period. Start by analyzing the company's historical financial performance. Look at trends in revenue, expenses, and capital investments. These give insight into the company's ability to sustain or grow its cash flow. Tools such as income statements and cash flow statements will be your best friends here. Next, consider factors that could impact future performance. Is the company expanding into new markets? Is competition stiffening? Are costs rising due to supply chain issues? These variables will help you refine your forecasts and better reflect reality. When projecting, keep timeframes realistic. Most analysts use 5-10 years, depending on the business's stability and industry. Break down these projections year by year, estimating free cash flow, the money left after operating costs and necessary investments. For added clarity, ask yourself, if I owned this business, how much real cash could I expect over time? That's the essence of this step. Discount rate. The discount rate is what brings future cash flows back to their value today. It's a measurement of risk and opportunity cost. If you ignore this step, your DCF analysis loses its credibility. So, what is the discount rate? It's often the company's weighted average cost of capital, WACC, the average return investors expect for providing capital, whether through debt or equity. For startups or riskier ventures, you might use a higher rate to account for the uncertain nature of their projections. But how do you calculate it? WACC combines the cost of equity, how much shareholders expect in return, and the cost of debt, interest rates on borrowed funds. For public companies, the capital asset pricing model, CAPM, is commonly used to estimate equity costs by factoring in the risk-free rate, market risk, and the company's beta. Why does it matter? Because time and risk degrade value. By applying the right discount rate, you're recognizing that $1 received 5 years from now is less valuable than $1 today. The rate helps weigh the risk against the reward, ensuring you're not overestimating worth. Terminal value. Every business has a value beyond the projection period. That's where the terminal value comes in. It captures the company's worth at the end of your forecast, assuming it will continue operating indefinitely. To calculate terminal value, two common methods are used. Perpetuity growth model. This assumes cash flow grows at a constant rate forever. Use this formula. Terminal value equals final year cash flow times 1 plus growth rate, discount rate minus growth rate. Here, be realistic with the growth rate, it's usually tied to the economy's long-term growth. Exit multiple method. This approach estimates value by applying an industry-based multiple, like EBITDA or revenue, to the company. For example, if your industry's average EBITDA multiple is 8x, multiply the final year's EBITDA by 8 to get terminal value. Terminal value often makes up a major portion of the final valuation. Why? Because many businesses expect to generate meaningful cash flow beyond the 5-10 year projection window. Think of it as the cherry on top of your analysis. In short, it answers this question: if we sell the business after X years, what's it worth? By mastering these components, projections, discount rate, and terminal value, you'll have a structured, reliable approach to estimating a business's true value. Each element complements the others, providing a clearer financial picture for savvy decision makers. Step-by-step guide to performing DCF analysis. Performing a discounted cash flow, DCF, analysis might seem complex at first, but breaking it into clear steps simplifies the process. From collecting key financial data to applying calculations, this guide will walk you through every stage of the process. Here's how to do it. Gathering financial data. Before crunching numbers, you need accurate and reliable financial data. Think of this as building the foundation for your analysis. Without the right information, the results won't hold water. Here's what you'll need. Historical financial statements. Gather at least 3-5 years of income statements, cash flow statements, and balance sheets. These help analyze trends and the company's financial stability. Revenue projections. Look for estimates or make your own based on expected business performance. Operating costs. Include both fixed and variable costs, as these directly affect profit margins. Capital expenditures, CapEx, document past and intended investments in assets like equipment or facilities. Working capital changes. Review how accounts receivable, accounts payable, and inventory fluctuate over time. Tax rates. Use the company's effective tax rate or applicable regional tax rates. Having all this data in hand ensures a smooth workflow. Skipping this step is like trying to bake a cake without the right ingredients. Calculating free cash flows. Free cash flow, FCF, represents the cash a business generates after paying for operating expenses and capital expenditures. It's a key figure in DCF as it reflects the true value a business offers. Here's how you calculate it. Start with net income from the income statement. Add back depreciation and amortization, non-cash expenses. Subtract capital expenditures, CapEx, found on the cash flow statement. Adjust for changes in working capital, fluctuations in current assets and liabilities. The formula looks like this. Free cash flow equals net income plus depreciation, amortization minus capex minus change in working capital. After determining the FCF for recent years, project it into the future, typically over 5-10 years. Use realistic growth rates based on historical trends, industry outlook, and market conditions. Don't overestimate. Aim for forecasts that align with the company's current trajectory. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.